Before we begin, please support the channel by subscribing, liking, and sharing this video. Constructive discussion is always welcome, and we invite you to share your views and insights in the comments.
All right, today we are diving into the U.S. Market Analysis Report for Thursday, March 19th, 2026. And just so we're all on the same page, this video presents a direct informational narration of the source document.
This document is provided solely for informational and research purposes and does not constitute investment advice, a recommendation, solicitation, or an offer to buy or sell any financial instrument. Investing in financial markets involves significant risk, including the potential loss of principal. Prices of equities, indices, derivatives, digital assets, and other financial instruments may fluctuate materially and unpredictably. All strategies, market views, and analytical content are presented for reference only and do not constitute trading instructions, portfolio management guidance, or guarantees of future performance.
So, let's quickly run through our agenda for today. We're going to kick things off with the day's opening dynamics, then dive into the major geopolitical shocks and the retreat in the energy market. After that, we'll cover a really critical technical test for the S&P 500, review all the market sectors, and then we'll wrap up with a look at institutional strategy.
All right, let's jump right into Section 1, Opening Market Dynamics, which will give us a great overview of the day's volatility logic.
The U.S. equity market is really caught in a sharp psychological tug-of-war right now. The S&P opened at 65.83, and pretty quickly we saw a sell-down to 65.57 thanks to some geopolitical pressure. This squarely tested that core support zone at 65.70. You can think of it as this really intense battle between the risk of a systemic breakdown on one side and some extreme tape support, that is, the underlying order flow, on the other.
Now, this brings us to a really core trading rule. Key technical levels are judged by the open or the close. So why does this matter so much? Well, while all those moves during the day can just be noise, the opening and closing prices, those are seen as representing true institutional intent. It's a logic that's deeply baked into the models of modern systematic funds.
And we actually saw that institutional intent play out in real time. Right around 3 p.m., the market staged a pretty violent V-shaped rally. All four major indices improved, and the Russell 2000 even managed to close in the green. This was a really clear tactical attempt by bullish capital to defend the market at these critical levels. But, as we're about to see, that defense was challenged pretty quickly. So let's move to our next section to see how this all builds. Section 2 covers geopolitical market shocks, and we're going to focus on the dual impact of remarks from Prime Minister Netanyahu, because right now geopolitics has become the core short-term variable that's driving this market.
The price action at 3 p.m. perfectly shows just how fast that geopolitical risk premium can be compressed and then just as quickly reconstructed. So first, we got the positive phase. Prime Minister Netanyahu stated that Iran had lost its core uranium enrichment and missile production capabilities. Now that comment really eased fears and drove a rapid rally. But then came the turning point, what the source document calls the butt layer. He added that Israel would continue pursuing leaders of the Iranian Revolutionary Guard. And that sudden shift in tone, it capped the rebound and sent the market right back into wide-range volatility.
You can imagine that kind of reversal in rhetoric immediately forced the market to reassess energy supply risk. And this brings us perfectly into Section 3, the energy market retreat, which focuses on the policy-driven cooling we saw in oil prices.
The volatility in energy prices is really the core anchor for inflation expectations. Today, Brent crude touched a high of $111 before pulling back. And this wasn't just some technical move, it was the result of some very systematic expectation management.
So the crucial point is understanding the catalysts that were behind this retreat. First off, Israel indicated it was unlikely to strike Iran's South Pars gas field again, which took the most extreme supply risk off the table. Second, Secretary Yellen signaled a potential release from the Strategic Petroleum Reserve. And third, the White House rejected an export ban on refined products, which helps to preserve global energy flows.
So while softening oil prices definitely provided some breathing room, a major technical warning sign emerged. Let's look at Section 4, the S&P 500 technical test, which details the first break of the 200-day moving average. And this is the most severe test the index has faced since May of 2025.
Now, from a technical strategy perspective, this is a pretty significant event. The S&P 500's 200-day moving average sits at 66.19, and the index itself closed below that critical line today. And this just brilliantly illustrates a key divergence. While the S&P index broke its key level, the S&P 500 ETF, ticker SPY, just barely managed to hold its critical closing level at 567. This kind of trend break can easily trigger automatic selling from systematic funds. And with triple witching expiration this Friday, that's a day when several types of options and futures contracts expire all at once, volatility is very likely to stay elevated.
Meanwhile, the economic data is just adding another layer of complexity. The latest initial jobless claims declined from 213,000 down to 205,000. On the one hand, this signals a resilient labor market, which lowers the probability of a recession. But on the other hand, it also squeezes the Federal Reserve's room to come in and rescue the market with aggressive rate cuts.
So against this weakening index backdrop, capital is rebalancing intensely. This takes us straight to Section 5, a full-spectrum trend review of all 11 S&P 500 sectors. The gold standard here is really simple. Is a sector still trading above its 200-day moving average or not?
Okay, let's start with the weaker sectors. We're seeing financials, that's ticker XLF, testing a key support range between 48.4 and 49.2. Over in technology, or XLK, the defense is really happening in that core range of 134 to 145. And finally, consumer discretionary, XLY, is being heavily influenced by its big heavyweight Tesla, which is trading in a range right around the 380 mark.
Next up are the sectors most sensitive to energy costs. For both materials, XLB, and industrials, XLI, those surging energy prices are severely compressing their margins. And for the energy sector itself, XLE, the key battleground for bulls and bears is the inflection zone between 54.3 and 55.3, and its future path is tied directly to geopolitics.
And finally, let's look at the defensive plays. Healthcare, XLV, it remains an attractive safe haven for institutional capital, and it's holding above multiple major support levels. In contrast, while utilities, or XLU, is also defensive, we're seeing speculative money exiting those recent nuclear and AI trades. This suggests it's going to return to its more traditional role as a stable, dividend-paying sector.
So, with all of this in mind, where does this leave the professional institutions? Well, that brings us to our final section, institutional strategy guidance and the hunt for the real buy-the-dip zone. Based on a recent Goldman Sachs survey, the median response suggests that the 6,000 to 6,200 range on the S&P 500 is being viewed as the optimistic accumulation zone. However, and this is a really critical condition, this model assumes the Strait of Hormuz crisis gets resolved within 2 months. If that closure lasts any longer, this entire valuation logic becomes invalid. And that leads to the final warning from the report. Investors should not become obsessed with capturing the exact bottom tick. Patience is critical. In a high volatility regime like this one, capital preservation has to take priority over just indiscriminately buying every dip. So the crucial question this really leaves us with is this. In a market driven by sudden, unpredictable information shocks, is patience the most valuable asset an investor can possibly have?